Imagine an economy grappling with war, sanctions, and a looming financial crisis. Today, we dive into the current state of Russia's economy, exploring the impact of recent developments and the potential long-term consequences. Back in the spring of 2022, Russia's financial system seemed on the brink of collapse due to the war in Ukraine and Western sanctions. There were fears of banking panics and shortages of basic goods. However, the steps taken by the central bank and government economists managed to avert immediate disaster. Fast forward to today, the Russian financial market is experiencing relative calm, but the threat of overheating is becoming increasingly real. Inflation remains far above the target rate of 4%, and GDP growth is rapid. Salaries in sectors like banking, oil and gas, and IT are soaring, unemployment is low, and interest rates are high. This feverish growth raises the question, will it be followed by a recession, and what might the next crisis look like? Economic crises often arise from financial bubbles, growth funded by volatile foreign investments, and inefficient capital distribution. These elements can lead to cycles of growth, overheating, crisis, recovery, and renewed growth. A crisis is more likely when growth isn't accompanied by a commensurate increase in labor productivity. If consumer savings grow, but technological advancements in manufacturing do not, a crisis will eventually resolve this tension through the depreciation of savings. During periods of growth, inefficiencies are often overlooked. Over time, these inefficiencies make the economy fragile, so even minor concerns can trigger a crisis. Short-term consumer and corporate debt often lies at the heart of these crises. Depositors withdrawing money en masse can lead to bank runs, which are often sparked by bad economic news. In Russia, the scenario is somewhat different. The majority of the banking sector's assets are held by state lenders, and the rest are insured, making them effectively state obligations. This reduces the likelihood of a banking panic. Additionally, restrictions imposed by both Russia and the West have made it difficult for Russians to convert their savings into foreign currencies. Despite these safeguards, the risk of a crisis remains. In the Soviet era, periodic crises occurred despite the absence of banking panics, such as the currency confiscations of 1947 and 1961, or the deposit freeze in 1991. Today, Russia's economy is more flexible but still faces significant challenges. Parallel imports and import substitution have partially compensated for the government's failures and the economic fallout from the war. However, this growth is accompanied by increased inefficiency. Resources are being misappropriated, crime is on the rise, and the black market for firearms is booming. Favorable loan terms for war veterans and exceptional benefits for certain individuals and enterprises contribute to systemic inefficiency. As the war continues, material resources are being consumed, and inefficiencies are becoming more pronounced. The government is likely to manipulate statistics, introduce price controls, and secretly subsidize certain sectors. Eventually, these imbalances will force the state to retreat from its commitments to its people. This could take the form of confiscations, subsidy removals, price increases, or freezes on deposits and pensions. Even if the special military operation achieves its goals, Russia's financial system is unlikely to provide long-term stability for savers. Since before the invasion, funded pension schemes have been frozen, non-contributory pensions have been cut, and the retirement age has been raised. The burden on the pension system will only increase, making further cuts inevitable. Consumers are wary of investing in Russian financial assets and are instead spending on real assets, driving up inflation. The real estate market is a prime example, where consumers buying apartments often take out mortgages subsidized by the state. Such handouts will be difficult for the government to claw back. The International Monetary Fund, IMF, predicts that Russia's share of global GDP will decline to its lowest level since the end of the Soviet Union during President Vladimir Putin's fifth term. Despite sanctions and economic turbulence, Russia's GDP is expected to grow by 3.2% in 2024, nearly tripling the growth predicted in 2023. However, this growth may not be sustainable. New IMF figures suggest that Russia's share of global GDP will shrink between now and 2029. By 2029, 1 year before the end of Putin's term, Russia's share of global GDP is expected to fall to 2.706%, lower than the 2.83% recorded in 1998 during a major financial crisis. Russia's economy faces a complex future. While immediate financial collapse has been avoided, the underlying issues of inefficiency, war, and inflation pose significant risks. The steps taken by the government to manage these challenges will determine whether the economy can stabilize or if it will plunge into another crisis. As the world watches, the lessons learned from Russia's economic struggles will provide valuable insights for managing financial stability in times of conflict and uncertainty.